when we were kicking around ideas, we could have done a typical benefit seminar, or we could have done a typical commercial risk seminar, but we really wanted to get into topics that we think are important in this day and age for employers. So we tried to keep it extremely varied. The goal is, and kind of the structure of this will be similar to a TED Talk. So we have 4 speakers today. We'll keep the content moving quickly. There's a lot of data here, but we'll keep the content moving quickly. We hope to give you enough information that you leave here with information that maybe you hadn't known. And if you do leave here and there's something that you want to hear more about or have a deeper conversation on, you can reach out to me. We'll be sending this presentation out within the next week to everybody, especially for those that are getting SHRM credits. That information will be included in that. And we're happy to schedule up time with any of the speakers to learn more about any topic, okay? The other thing that I asked, we're going to keep it tight to about 35 minutes per speaker. Our goal is to get you out at 11 o'clock since we committed to that. What I always get fearful when we put a PowerPoint up is it becomes very one-sided. If you have a question, stop. Let's have a conversation around it. We can always pick up time as we move along. So don't hesitate to ask questions. I want to thank our partners, Dilworth Paxson and Preferred EAP. They're committing a lot of time and resources to this, and we think that it's a valuable agenda, so we really appreciate them partnering with this to deliver this content to you. Like I said, we will be sending out the information on the SHRM credits and the HRCI credits as well, right? So at this time, I'm going to bring up Matt and Stephanie. They're going to talk about their topic, and then we'll roll to Eric, and then Carolyn will finish up from Preferred EAP. Thanks.
Thanks, Dennis. Well, welcome everybody on this brisk fall morning. Everyone looks wide awake. Everyone must have had their coffee already, which is good. Everybody, remember to vote. A lot of what I'm talking about this morning, people either are going to like it or really not like it, and the way you can have some influence in the future on these types of issues is by voting. So everybody make sure you vote, because one of the worst things is to complain after there's a really low voter turnout. And I'd like to thank Dennis for all the work Univest has done in helping to put this together. So let me see what the good angle is here. Okay.
Do you want the microphone?
Okay. I hope I'm coordinated enough to do this. Okay. So I have a little bit of a cold. If my voice starts cracking and everything, people just bear with me. Okay, great. Tax reform update. So what does this mean? This means I had to change the outline 15 or 20 times in the last 5 days. Okay. So this thing is all over the place. But so people, I think, probably know sort of what happened here. There was this group called the Big Six, which was the Secretary of Treasury's Mnuchin and Gary Cohn, who's the sort of the finance guy and the White House advisor, and Paul Ryan and the Senate. And they came up with sort of what they call this like blueprint. So the blueprint got passed by the Senate and the House, and it's done in a way that they're using reconciliation. So what reconciliation means, you can pass through the legislation without any votes from the opposite party. In this case, you only need a simple majority. That way they don't need any votes from Democrats. The big trick, and there's going to be some more stuff coming out on this today, is you can't raise the deficit after a 10-year period when you use a reconciliation bill. So the idea was, could they possibly do everything they want to do, have all these, quote, tax cuts, close quote, and not cause the deficit to increase after a 10-year time frame. So here are some of the key things that are in this tax bill, which is called the Tax Cut and Jobs Act. So there was a lot of changes in the brackets. They cut the brackets from 7 to 4. I have all the cutoffs here. One of the really tricky things that was just noticed kind of over the weekend, when people, the bill, by the way, is over 400 pages. So one of the tricky things that was noticed over the weekend is that for certain taxpayers in that 39.6% high bracket, which is one of the issues with high wage earners continue to pay at the high bracket, there's actually a phase out of the 12% bracket. These are marginal brackets. So if you phase out the 12% bracket for some of these really high earners, they're actually paying an effective rate of 45.6%. And it's actually even worse than that because you have to add in the 3.8 additional Medicare tax. So I guess nobody noticed that until some tricky lawyer or accountant saw it over the weekend. So here's some of the things that are raising a lot of ire, I guess, all over. There's a limit in this bill on mortgage interest deductibility if the mortgage is over $500,000. Right now, the cap is $1 million. I saw this morning that in the markup, you know how these work, these bills are then marked up by the House and Senate committees, and then they come to a joint resolution. I saw in the markup that Brady did, who's chair of the Ways and Means, the Senate apparently is going to put back the $1 million cap in their version of the bill. The other one that's raised a lot of interest is the removal of the deduction for state and local income taxes, other than property taxes, and that property tax deduction would be capped at $10,000. No deduction for student loan interest, moving expenses, and alimony for future divorces. I did a little presentation in front of the family law section of the Bar Association yesterday, and I said, how many people got really upset phone calls last week when this bill came out? And you have to sort of delve into it a little bit. If your grandfather, current arrangements for alimony payment are grandfathered. It's only for divorces in the future, where alimony will no longer be deductible, which also means that the payee, the spouse who receives the alimony, doesn't have to declare it as income. So I guess in some convoluted way, that's kind of a family-friendly provision, because one of the ideas was to make taxes more family-friendly. So personal exemptions are eliminated under the tax bill. Dependent care assistance is eliminated under the tax bill. However, I saw yesterday that in the markup, dependent care assistance is now back in. So you can still have your flexible spending for a dependent care assistance program. Tuition assistance is eliminated as being a tax-free benefit, although there's a lot of talk that that will be restored. And one that drew a lot of attention was elimination of adoption assistance benefits. And that also apparently is going to be restored in the Senate version of the bill. The standard deduction is doubled. The estate tax exemption is doubled, and it's going to be phased out apparently in 6 years. And alternative minimum tax, which the idea was to sort of penalize people who took high deduction years ago. It ended up, because it wasn't adjusted properly, really affecting a lot of middle-class taxpayers. So that was, I think, the impetus for that. This is sort of the kookiest thing that's come up in this bill, and this has gotten really a lot of attention, especially in the Wall Street Journal. The idea was for pass-through types of businesses, which are S corporations or partnerships or sole proprietorships, where the income and loss passes through to the owners, to give them a lower effective tax rate. So the idea was to only have a 25% tax rate for these individuals, but they were afraid this would be abused. So how did they try to stop abuse? Lawyers, doctors, and accountants really can't use this provision because, even if they're set up as partnerships, because it's really intended for capital-intensive types of businesses, like manufacturing businesses where people are putting money into equipment, that type of thing. Though they could, in certain circumstances, maybe use it. So the other way to protect from abuse was to put in this 30-70 rule. So for actively managed businesses, 70% of the income is taxed at regular tax rates and 30% at the special 25% tax rate. But what's the really strange thing that happened? The small business lobby is actually complaining about this provision because a lot of small businesses, the owners of pass-through entities pay taxes at a rate lower than 25%. So it really isn't helping a lot of them. So we'll see what happens with that. The huge change in the legislation was lowering of the corporate tax rate to 20% from 35%. And this is something that actually Democrats and Republicans agree on. It's maybe the only thing that they agree on in this bill, because the U.S. tax rate in corporations was amongst the highest of all business in developed countries. Here's some of the other things. The child tax credit is going to increase, and that was the big thing that Ivanka was working on while she stormed into a couple meetings to talk about. And they added a new credit for parents and older family members, although I saw this morning that credit is actually going to expire, I think, in 2022 or 2024, so that's not even a permanent credit. The medical expense deduction was eliminated. As people know, over the past few years, it used to be medical expenses over 7.5% of adjusted gross income were deductible, then it went to 10%. They've now totally eliminated the deduction, so that's going to draw some higher. They're going to allow certain business expenses to have immediate write-off, which wasn't allowed before. There's sort of a mandatory repatriation of offshore earnings of U.S. businesses. And it's at a one-time low rate. I think it's 12% for cash and 5% for property. The big thing that people probably read about this was the 401k limitation for pre-tax deductibility was going to be adjusted and moved downwards. There was a lot of talk it would move down to $2,400 a year, so the maximum deduction you could get for your 401k would be pre-tax would be $2,400, and the rest you would have to put in on a Roth after-tax basis. There was a huge amount of complaining by different groups about that, so that was dropped from the bill. But this is just my own conjecture. I have a feeling that when some of these changes are made, some of these things that were eliminated or put back into the bill, that they have to get some money from somewhere to make this 10-year reconciliation requirement, that there still may be some adjustments to the 401k limitation. And I saw in the press yesterday that discussions have begun again about maybe adjusting the 401k limitation. Okay, any questions about the tax bill? Okay, yeah, it's wait till next week or the end of this week to start reading articles again, because the markups are supposed to be finished this week, and the Joint Committee on Taxation will probably publish some more understandable stuff this week. Oh, whoops. Okay, next thing I wanted to quickly go through what's going on with the ACA. So everybody knows there were numerous attempts in Congress and Senate to repeal the ACA or Obamacare. A lot of this was, there would be block grants, reallocation of Medicaid. Rand Paul was pushing this thing to have cross-state insurance sales. And this kind of ended up not going through after a lot of bickering and fighting amongst the Republicans. Then the administration issued an executive order which ended up eliminating cost-sharing payments that would go to insurers as in the form to subsidize the coverage. Then the president indicated that they may still come back into play if there can be some type of bipartisan deal, which is yet to occur and probably will not occur for a while. Oh, and I should add that as far as the tax bill goes, there's now been some discussion of trying to add to the tax bill a repeal of the individual mandate under Obamacare. But I think Brady, the chairman of the House Ways and Means Committee, said we're not going to try to add that on here because they think they're going to have enough trouble trying to get the legislation through Congress without getting into Obamacare again. So Obamacare is still the law. There's still these exchanges. There's still the Medicaid expansion for poor adults. So you still have to comply with the ACA, meaning if you have a summary of benefits and coverage, which I think if you do HR, you know what that is. That's that short summary of what your medical program is. You're supposed to redo it on an updated template that was effective in April. All the reporting obligations still exist. However, there's a reduced financial support of the exchanges under the Trump administration. The advertising budget was cut by 90%. There's fewer grants to consumer groups to help people enroll, and enrollment is only open until January 1st, 2018. So it just opened. So it's only basically 45 days for people to try to figure out what kind of coverage they need on the exchange. There's a bill up in front of the Senate, which will probably be delayed for a while, to simplify reporting for employers under Obamacare. And they're putting some rules where you can voluntarily report, which will simplify what you have to do on Form W-2 and 1090 and the 1095s. In 2016, returns were allowed to be filed, and you could leave your Form 1040, you could leave out your coverage level under Obamacare. But for 2017 returns, the IRS now decided that if you file electronically and don't complete your ACA health coverage reporting requirement, your return will be deemed incomplete, and paper returns will be suspended until the necessary information is provided. And taxpayers still have to pay the individual mandate tax, unless, of course, it's added to the tax bill and repealed. A big issue has been this contraception mandate that was in Obamacare. Originally, churches and synagogues, houses of worship were exempted, and then there was an exemption for religiously affiliated entities like a Catholic hospital, that type of thing. And they got a certain procedure where people could work around the hospital actually providing it and would deal with the insurer subject to reimbursement by the federal government. Well, the Trump administration really expanded this rule, and now for-profit businesses, universities can raise religious belief or strongly held moral objections, and they don't have to cover contraception, so it's very broad. There's no notice to the government or certification required if an employer elects to do this, but ERISA probably requires a summary of material modifications or some explanation of how the coverage has changed. And employers can still request accommodations, but they're optional, not required any longer. And this is a big expansion of a case you guys have probably heard of called Hobby Lobby, which was a Supreme Court case that said closely held family-owned business can have religious beliefs, basically. So this, what the administration did, is basically an expansion of this for closely held businesses to all types of businesses, including publicly traded entities. In the administration's executive order, they've also asked basically the various government agencies to loosen a lot of their rules. One thing they're particularly interested in is these association health plans, which is sort of on the Rand Paul idea that if a large employer operates in a lot of states, they get the choice of a lot of different health coverages. The idea of this is the same thing. You get a lot of different employers who have some commonality of interest or geographic similarity to join an association, get choices of plans, more choices of plans, and the idea is this would be expand ERISA to change the definitions to make this type of thing work, which would preempt state laws. And they want state laws to be preempted because a lot of state laws have reserve requirements and benefit requirements, and they don't want them to apply. So it's really sort of a lower, probably would promote a lower level of coverage, because these AHPs would not have to offer all the mandated essential health benefits that are otherwise required under the ACA. But parts of the ACA, unless it's repealed, would still remain in place, like the requirement to cover dependents until age 26 and annual and lifetime limits. What was released by the administration also said these association health plans wouldn't have any pre-existing condition exclusions as well, so basically anybody can enter them. The executive order also asked DOL and the Treasury Department, Health and Human Services, to loosen a lot of their requirements. They basically want to allow people to militate towards less expensive plans. The problem is if you have a provision like this, what could end up happening is younger people or healthier people go to a certain type of plan, leaving the more sickly and older population behind to end up in a plan with very high premiums. So a lot of state regulators are really concerned about this. Some of the other things in the order were to now have short-term limited duration medical insurance, which under the ACA is now only permitted for 90 days. This would go up to 180 days. These are sort of policies that don't have a full range of benefits. And they are exempt from most of the ACA's requirements. Another issue that's come up is expansion of health reimbursement accounts. I don't know how many of you guys are involved with health reimbursement accounts, but under the ACA, if a health reimbursement account was used to reimburse employees so they would buy individual coverage and to get the employer out of having to provide group coverage under the ACA, the government said that the HRA basically then was a form of a plan that was covered under the ACA. It constituted a group health plan, meaning it had to comply with all the requirements of group health plans, which an HRA can't do because obviously there's a fixed amount of funds going into the HRA each year, so there's an annual limit on what the HRA can pay. Well, this executive order would loosen these requirements. They will allow employees to use HRAs to buy coverage in the individual market. And I don't know if anybody's got involved with any of these QSARAs, which are qualified small employer HRAs. They were already exempt from a lot of the ACA requirements and the rule I just talked about, the annual limitation limit. Guidance was just issued that say that these don't conflict with HSAs. I don't know if everybody here offers HSAs. You know, HSAs, when you have an HSA, the only coverage you're allowed to have is a high deductible health plan. You can't really have any other health benefits, except sometimes for certain things like dental and vision maybe would be accepted. This said that these QSARAs do not conflict with HSAs, so you can have a health savings account and one of these special qualified small employer HRAs. I think I'm finished with my presentation. I'll turn it over to Stephanie.
Hey, Matt, I have a quick question. So with regards to the new tax filing, does an employer have an obligation to let their employees know about that?
Which one are you talking about, Dennis?
The electronic filing and making sure that they're filing the appropriate stuff.
I don't really know the answer to that. I guess maybe that remains to be seen.
Okay.
A good response. So a lot of this stuff is very nebulous because it just came out. So there's no regs nor really great guidance on a lot of it. It's just sort of all coming together right now.
Great.
I'm Stephanie Searles. I'm an associate here at Dilworth Paxson. I work closely with Matt doing employee benefits work, and I also do a lot of tax work. So I'm going to talk about plan correction programs. The IRS has the Employee Plans Compliance Resolution System, known commonly as EPCRS or EPCRS. EPCRS has 3 different ways to correct plan errors. The first one is known as VCP, Voluntary Correction Program. We'll talk about that later. The second one is audit cap, where you really, really do not want to find yourself because that's going to cost your business a lot of money. And the third one is self-correction program. So any operational error that's considered insignificant, which is defined as a facts and circumstances test, which looks at the ratio of total participants impacted by the error and the total amount of money involved. And also errors that occur, that are corrected at the end of the second plan year following the error can be corrected via self-correction, which essentially is just correcting the error and writing a memo to the file and keeping records of what happened in case anything goes wrong down the road. So the first one I'm talking about is the VCP, the Voluntary Correction Program. And right now, VCP is probably about half of the workload that Matt and I have with employee benefits programs. That's because many plans that were required to be audited, their auditors found errors. And VCP can be used to correct a number of operational errors, can be used to correct plan document errors. Sometimes the IRS permits retroactive amendments, and you can also correct errors involving demographic features. The IRS has forms available that you can use to correct common plan failures. Every VCP application is prepared using an IRS Form 8950, which gives basic information about the plan sponsor and the error that occurred, and requires exhibits to be attached showing why the error occurred and showing how you corrected it. Employers can choose to go into VCP anonymously. They would want to do that if they were, if the error was on the more egregious side, and if they were afraid that, this may not get through, and they don't want to, raise a red flag to the IRS, hey, come after us. So there's user fees involved with EPCRS. Those user fees, let's see, range anywhere from $500 to $15,000. $15,000 is only for employers that have over 10,000 employees. So most employers are paying in the $5,000 range. If you go in anonymously and the IRS does not accept your VCP, you do not get your user fee back. So that's one reason why you might not want to go in anonymously. If you don't go in anonymously and the IRS is just like, we cannot accept this correction, they'll give you your money back. And so there's also special rules for missed affirmative 401k plan deferrals and auto enrollment failures. This is one area where Matt and I see a lot of issues. We actually had a very successful VCP with one of our clients who had a QACA, qualified automatic contribution arrangement. We did the correction in 2016. They had the plan in place since 2014, but they told us that they told their TPA to turn off the QACA, which, if any of you are familiar with it, you can't just turn off a QACA. It involves a plan amendment or something more affirmative than just saying you turned it off. So we corrected, 3 years for a lot of employees, and the IRS accepted it. We made some negotiations, and we were a bit tricky with our corrections, but it ended up being a good result for everyone all around. And that also prevented the plan from being disqualified. As you know, if a plan is disqualified, significant tax implications both for the employer and the participants. Audit Closing Agreement Program, otherwise known as Audit CAP, is where you really, really, really do not want to find yourself. Audit cap occurs when a plan is being audited and the IRS is the one that tells the employer or the plan sponsor about the errors that it has found. So how this works is that the errors are corrected, and then the employer enters into a closing agreement with the IRS. The difference here is that what the plan sponsor pays is significantly higher than the VCP user fee. IRS Rev Proc 2016-51 defines what the maximum payment amount can be, and that essentially is the maximum amount of taxes that the IRS could collect if the plan was disqualified. So think about the number of participants. All of the contributions to the plan would be subject to income tax, and the employer would not get any deductions for any employer contributions. So, if there's, hundreds of employees, that can be pretty significant. So, once corrected under EPCRS, whether VPC or audit cap, the applicant will receive a compliance statement, which is essentially a letter from the IRS saying that we understand you've had errors, you've corrected them, here's your compliance statement, your plan is fine, no risk of disqualification. However, the IRS has up to 150 days after the compliance statement, to come and make sure that all errors were actually corrected and that the programs that you have in place to prevent the errors from going forward have actually been implemented. Okay, so the next set of correction programs are the DOL correction programs. The first one is the Voluntary Fiduciary Correction Program, otherwise known as VFCP. There's no user fee, and like the VCP, there's model forms that can be used. You usually have to attach information about the errors occurred and the ways that the errors are corrected to the VFCP, sorry. And the most common error that you would use the VFCP for is when the error involves missed employee deferrals. So it's when the employee's money is actually deferred from their paycheck, but not timely or never put into their 401k account. So what you have to do is you have to put the money back in, and you have to also put in missed earnings. Missed earnings can be based on the actual rate of return, or they can be calculated using the DOL calculator, which is available online. Often the DOL calculator is a lower rate, especially when the market's doing well. And other errors can be used with the VFCP, so loan failures and fiduciary breaches. The DFVCP is used when Form 5500 is filed late or not filed at all. And there is a user fee involved with this as well, but the fee is often less than the penalty will be. On the first page of the 5500, there's a box for the DFVC program, so you'll check that off on the Form 5500. There's a per filing cap, $750 for a small plan, $4,000 for a large plan. A small plan is generally defined as less than 100 participants. A large plan is anything over that. There's also a per plan cap. So if you have multiple years of missing Form 5500s, it's $1,500 per small plan and $4,000 per large plan. And there's a small tax exempt organization plan fee of $750. So the online calculator is used to calculate the penalty amount, and IRS usually abates late filing penalties if this DFVCP program is used. So that can be a huge savings if a plan sponsor is looking to get all the administrative issues corrected with the plan. And that's the end of the plan correction programs. This is Matt's profile in case anyone is interested. Does anyone have any questions for me or Matt?
Yeah, I would add one thing. Thanks, Stephanie. That was great. I would add one thing. It always makes sense to probably go in voluntarily if you see that you have a problem with your 401k plan or other retirement plan, because you get a much bigger break when you go in voluntarily. If you're being audited and you haven't gone in voluntarily, you're going to get stuck in audit cap, which is the sanctions are much higher than if you had just gone in and paid the user fee generally and admitted what you've done to the service. On the Department of Labor side, a lot of times when we see mix-ups, clients say to us, "Oh, that's de minimis. That's a couple $100." So, for example, if you have 401k deferrals or participant loan repayments to a 401k plan that you don't deposit timely into the trust fund for the retirement plan, clients say to us all the time, "What do you mean? That's a couple $100? I'm not, doing anything." That's a very major error, because from the Department of Labor perspective, there's no such thing as a de minimis exception. So if you've held participant deferrals or participant loan repayments for longer than is a reasonable period of time in which you could have deposited them, that's a per se prohibited transaction.
And even a couple days over that reasonable period of time,
right,
you have to calculate the missed earnings, even if 1 or 2 days.
Right, so there's no de minimis rule whatsoever. So it's better to go in voluntarily and report than get in trouble later down the road, because you don't want to deal with the Department of Labor on an exam. They're very difficult to deal with. and the IRS is a little bit less difficult to deal with, but still not easy to deal with. So the idea is they want voluntary compliance. They don't have enough employees to chase everybody down. So it's better, talk to counsel and think about going involuntarily when you notice you have a significant plan issue.